Welcome, ladies, to the Real Estate Investor Show, providing inspiration, strategies, and insight to empower women investors to live balanced and financially free lives. Now, here are your co-hosts, Liz and Andresa.
Welcome back, ladies. This is Liz.
And this is Andresa.
Welcome back to the Real Estate Investor Show. We're on a mission to empower women to live a financially free and balanced life. And you are back with a minisode. And I'm going to be talking about how to thrive in a looming recession today.
What are you talking about? Did you bring your crystal ball?
Yes, I did.
Awesome.
Okay, so I'm going to be talking about, I say looming, right? I cannot tell you if there's going to be a recession, when the recession is going to be, and what it's going to look like. I would have to get paid a lot more money for those types of details, right, Andresa?
Yep.
But I will say that there's a lot of talk about a recession, and as you do more research, there's different pieces that wouldn't surprise me if a recession happens, right? So regardless of when and how, most important thing we can do as investors is to set ourselves up for the most success and not be stopped, right, with what's happening. So as I'm a big fan of moving forward, but we have to move forward with being smart and conservative and not just, put your hands up and just, put your head under the pillow and go to bed, because that's never a good idea either. So I think you could thrive, not just survive. So here's some thoughts, here's some ideas for you as you navigate what we're experiencing. First thing I would be doing is getting on the phone with your lenders or lenders you're considering to work with. I know a lot of people that are in the middle of a refinance. They're in the middle of purchasing an investment property, and the interest rates, the LTV, loan to value that they were quoted a month ago is changing, right? Has changed in more of a conservative way, right? Probably not in your favor, in the bank's favor. So this is a really important time, whether you're in the middle of projects or you're about to begin a project, to start making sure you're clear on what the current rates are, what the current products are, all of them, and you really need to make sure you talk to obviously the right people at the bank. There are banks that are going to be naturally more conservative during these times. All banks are conservative, but there is a varying degree of conservativeness in banks, in my opinion, in lenders. Some banks are going to still keep lending right now. Some banks are probably being told not to, and some maybe even could be a little more aggressive because they know they're going to get an opportunity. There's all different types.
And Liz, you're making a good point. You know why? Because don't assume that the bank that you're currently working with did not adjust. They did, and they are currently, dancing with the Fed right now, back and forth. Banks that were doing 90% LTV on refinancing less than a year ago are doing only 80% LTV to certain clients. To the general public, majority 70 to 75. So idealize new relationships, but look forward to build more relationships with your current bank. And make sure that you double check and you don't run the numbers as if, you did 6 to 1 year ago.
Yeah. Critical. Yeah. I was talking to a friend the other day and she had said, this bank is lending me a construction loan. This bank is doing various things with me. And then she's considering other lenders. I said, quite honestly, the lender who's going to want to work with you the most is who's already lent you money, right? Yeah. They've already worked with you. They've already vetted you. So you got to remember they're mitigating risk. And if they've worked with you before, you're a repeat borrower, they've already lent you money on some level, the risk is decreased versus you're brand new. Your risk is already increased there because they don't know you, they haven't vetted you fully. And that's for experienced investors and newbies, quite honestly. So I remember going to a couple of banks and they're a little cautious because they're just cautious with new borrowers. Second thing to keep in mind is cash is king, right? So, as the market, the market readjusts. So you definitely, I remember when the market crashed in 08, 09, and I wished we had more cash aside. We had really deployed a lot of our cash in our rentals. And then 2010 and 11, right? If you had cash and a lot of it, you did well by picking up a lot of the properties that were getting, redeployed. So same thinking here, right? So if you can get a HELOC on your home, or, start to be mindful of your cash, right? And what's liquidity, if you will. Right now, you should be trying to get liquid on something so you have it to deploy into an opportunity, or to just have buffers, right? And to have that kind of conservative money aside, if you will. Just a reminder on that. The other thing I'd say is networking and market research is really important all the time, but it's certainly right now in terms of what's happening. Meaning, are you networking with investors in the area that you're looking to invest in? Are you doing your market research?
Yeah.
Are you? Because right now, if people are getting nervous, could be a good time to buy, right? There's not 20 offers on a property. There maybe are 3. So again, remember, you want to be mindful of what's happening, but in some ways, the market being not so hot is a good thing in and of itself. Now, you got to set yourself up for success with the financing piece, right? That would be critical. But remember that the psychology of the world, the psychology of the economy is that people are like, hold on. Now you have an opportunity. Now you're like, hold on, I can actually jump in a little bit easier now. There might be more properties on your plate. Those are good things. Okay. So, but you have to really make sure you're doing your market research now, not like later. You constantly sharpening your saw with relationships and market would be my big suggestion as well. Does that make sense, Andresa?
Yeah. I hate seeing people looking at properties. It's a waste of time if you don't know the market. Know the market as the palm of your hand. You've got to know days on the market. You got to know the price as and the price after the ARV, the after repair value. I usually do the after repair value if I am selling now, right? Now, will the numbers work? I don't use appreciation. I do not use none of that. How the market it is right now, you need to consider what's the worst case scenario, right? Don't play into, I can ask whatever the hell I want in 6 months from now, 9 months from now. If you're building, especially if you're building, things might change. So you've got to play your worst case scenario too if the market shifts.
Yeah. And this is literally the worst time. If everything, the kind of deals that if everything works, then the property and the project will work well. In other words, all the stars have to align. Like that's not a good strategy right now because because you can't, there's so many uncontrollables. So it's like, what can I control? What can I control? The biggest thing too, as you're getting properties across your plate is doing a break-even analysis. You could do a break-even analysis on your current assets. You could do a break-even analysis, obviously, on properties you are considering. So what do I mean by that? It's, especially from like you can use this for short-term rentals. You can do this for long-term rentals. It doesn't really matter, but your analysis would be a little different. If it's a short-term rental, how many nights do I have to, have occupied in my property for me to break even on my financial obligations? Right? That's what you're in a simplistic way. That's what you're trying to assess. If it's 95%, right? That's not good because that means, again, all the stars are aligning, that analogy. For example, Andresa and I, we partnered with Andresa Group on a 670 unit. And for us to make all the financial obligations of those 5 properties, the 5 properties had to be 60% occupied, meaning 40% of the properties could be vacant or non-paying tenants, right? Not just vacancy, but you have to consider non-paying tenants as well. They could be occupying the space, but they're not paying, right? You're not bringing that revenue in. So I'm not saying or suggesting every property has to have a 60% break-even occupancy. What I am saying is that you need to know what that is. And you need to make sure financially that you are bracing yourself, right? And making that right call, saying conservatively, does this make sense? If break even is here, okay, what's the worst case scenario? What's the worst case scenario? And then once you ask that question a couple of times, both from an interest rate perspective, both from a cash reserve perspective, both from a what did this market do in the last crash perspective, then you in a very educated way, you make the call. I'm a big fan of buying properties in any market. But certain markets, you need to be more conservative. For me to tell you, go for it, is nonsense right now. But I certainly say don't get stopped.
I want to highlight what you're saying about the looking back and doing the stress test. We did this in several markets that we were looking to invest first. So when we are looking to invest in a market for the first time, we do a stress test, and then we look at the recession. How we look back at all the numbers, the data. What did the market do during the recession? And then we see, okay, did it go super up and down, or it barely made any change?
Yep.
It does not mean that that's going to happen again, but history data, it's important for you to make a decision when you are doing a stress test.
Absolutely. And I can't stress it enough that there is an economic landscape that happens nationally, internationally, but we all know real estate is hyper local. So to say your local market is the same as another local market is not fair. Now, I'm not saying that's an excuse to be like, well, it doesn't really matter what's going on in the world. My local economy is booming. That can be the case, but it will be affected, right? Because everything trickles down, but it may not be as affected, right? It may not have the same impact as another market. And that's why the historical looking in the past is really, really powerful, because, not saying this, a pending recession wouldn't be the exact same, but it's just, again, more data. And then you make the decision. So to thrive in this market and to thrive in any market is to get the data, make sure you're not just going off of Aunt Sue or Uncle Tim's advice. They're just watching the CNN. Don't listen to them if they don't invest in real estate. You got to listen to real teachers. You got to really listen to active investors. But by all means, you got to be conservative right now. And you got to make sure you get all your numbers and you feel good about that break-even analysis, and you go for it. And you do that refinance, or you buy that property. But you can't be cavalier in this market, because you're going to get burned. So that's what I have for you today. And I always say, you can thrive anywhere and any time. Just make sure you're surrounding yourself with the right people.
If you enjoyed this podcast and want to receive updates on our next interviews, go to our website, therealestateinvestor.com. There, you can subscribe to our show, become part of our investor community, and get updates on upcoming episodes.
If you like our show, please share it with other women who would benefit. And don't forget to leave us a rating on iTunes. We'd really appreciate it. And as always, we encourage you to take one action as a result of today's show and put it into motion so you can live both a financially free and balanced life. Thanks for spending time with us.
Ciao.